Imagine two people. They earn almost the same salary. They graduate around the same age. They live in the same country. They face the same economy. 30 years later, one has built financial freedom. The other is still worrying about money. What happened? Was one simply luckier, smarter, better connected? History suggests something far more interesting. For over 2 centuries, markets have created extraordinary wealth. Yet, the vast majority of people never fully benefit from them. Not because investing is impossible, but because most people misunderstand what investing really is. They believe success comes from predicting the future, finding the next winning stock, timing the market, following experts, chasing headlines. History tells a different story. The investors who built lasting wealth often shared something surprisingly simple. They followed principles that rarely changed, even when the world around them did. Markets change, principles don't. And by the end of this documentary, you'll understand why that idea has quietly created more wealth than almost any prediction ever made. Welcome to Evergreen Investor. This is not a channel about chasing trends. It's not about getting rich overnight. It's not about predicting tomorrow's stock market. Instead, every documentary we create explores the timeless principles behind rational investing, long-term wealth building, and financial decision-making. If you're building wealth for the next 10, 20, or 30 years, you're in the right place. Here's a surprising question. If the greatest investors in history followed different strategies, why did they all end up believing in almost the same principles? Warren Buffett built one of the greatest investment records ever. John Bogle transformed investing through low-cost index funds. Benjamin Graham created the foundation of value investing. Peter Lynch consistently outperformed the market by studying businesses ordinary people already knew. Ray Dalio developed one of the world's largest hedge funds through diversification and risk management. Different people, different eras, different methods, yet their advice repeatedly points toward the same ideas. Think long-term, stay disciplined, ignore the noise, protect your capital, never stop learning. That's not a coincidence. It's a pattern, and patterns are where lasting wealth begins. During this documentary, we'll explore the timeless principles that have survived market crashes, economic booms, technological revolutions, inflation, recessions, and decades of uncertainty. You'll discover why most investing mistakes have little to do with intelligence, why psychology often matters more than predictions, why simplicity frequently beats complexity, and why building wealth is usually less about finding extraordinary opportunities than avoiding ordinary mistakes. Let's begin with one of the biggest myths in finance. The idea that successful investing is about constantly buying and selling. Financial news makes markets feel like a never-ending emergency. Every day brings another headline, another prediction, another crisis, another opportunity that supposedly can't be missed. But step back for a moment. Ask yourself a simple question. If reacting to daily news created wealth, why aren't the people consuming the most financial news consistently the wealthiest investors? The truth is that markets generate enormous amounts of noise. Prices move every second. Opinions change every hour. Predictions change every day. But ownership of productive businesses, the thing investing is actually about, evolves over years and decades. This distinction changes everything. Investing is not the same as trading. Trading focuses on price. Investing focuses on value. Trading asks, what will happen next? Investing asks, what will matter 20 years from now? That difference may seem small, but it separates speculation from wealth building. And once you truly understand it, you'll begin to see the market very differently. Coming up next, we'll travel back through more than 200 years of market history to answer one remarkable question. If markets crash so often, why have they continued creating wealth generation after generation? Imagine opening a newspaper on October 29, 1929. The headlines are devastating. Stock prices have collapsed. Fortunes have disappeared almost overnight. Banks begin to fail. Businesses close. Millions of people lose their jobs. Confidence vanishes. To the people living through it, the future of capitalism itself suddenly feels uncertain. If you had been alive that week, it's difficult to imagine feeling optimistic about investing. And yet, looking back nearly a century later, we know something they couldn't possibly know. The market recovered. Not immediately, not easily, but eventually, and over the decades that followed, it reached levels almost unimaginable to investors living through the crash. This pattern repeats throughout history. Every generation experiences a moment when it believes, this time is different. And almost every generation discovers that markets have an extraordinary ability to adapt, rebuild, and continue creating value over long periods. Fast forward to the 1970s. Inflation surges. Oil prices explode. Economic growth slows. Confidence disappears once again. Then comes the late 1990s. Technology stocks soar. New companies seem unstoppable. Investors become convinced that traditional valuation no longer matters. Until the dot-com bubble bursts. Billions of dollars vanish. Once again, people wonder whether investing still works. Only a few years later, another crisis arrives. The global financial crisis of 2008. Banks collapse. Housing prices fall. Financial institutions fail. Markets around the world plunge. Television screens fill with panic. Experts debate whether the global financial system can survive. And then it does. Slowly, painfully, imperfectly, but it recovers. In 2020, another unexpected shock appears. A global pandemic. Entire economies shut down. Markets fall at record speed. Fear once again dominates headlines. Yet within a relatively short period, markets begin recovering once more. Different crisis, same emotional pattern, same human reactions, same long-term resilience. It's tempting to believe that every crash marks the end of investing. But history tells us something different. Crashes are not unusual. They are part of investing. Volatility is not a flaw in the market. It's one of its permanent characteristics. The investor who expects markets to move smoothly is almost guaranteed to become frustrated. The investor who understands volatility as the price of long-term returns is far more likely to stay invested. That's one of the first timeless principles of wealth building. Evergreen principle number 1. Volatility is temporary. Ownership is permanent. Prices fluctuate. Businesses continue operating. People continue working. Products continue being sold. Innovation continues. The market reflects human progress over long periods, not daily headlines. If history makes this seem obvious, why do so many people still panic during market declines? The answer has less to do with finance than with psychology. Human beings evolved to react quickly to danger. Thousands of years ago, ignoring a threat could be fatal. That instinct still exists today, except the threat is often a red number on a screen. Behavioral economists call this loss aversion. Research consistently shows that people tend to experience the pain of losses more intensely than the pleasure of equivalent gains. Losing $1,000 usually feels worse than gaining $1,000 feels good. As a result, investors often sell precisely when fear is highest. Ironically, those periods have historically been among the most rewarding times for patient, disciplined investors. Imagine planting an oak tree. During its first years, it barely seems to grow. Some seasons are harsh. Storms bend its branches. Winters make it appear lifeless. If you judged the tree only by one difficult season, you might conclude it would never become strong. But trees don't grow according to daily weather. They grow because their roots continue developing over time. Investing works in a surprisingly similar way. Daily price movements are the weather. Long-term ownership is the root system. The people who constantly dig up the tree to check its roots rarely allow it to grow. The patient gardener eventually enjoys the shade. But surviving market crashes is only part of the story. If simply staying invested were enough, everyone would become wealthy. Clearly, something else separates extraordinary investors from ordinary ones. It isn't secret information. It isn't intelligence. And it isn't luck. It begins with one of the most misunderstood forces in finance, a force Albert Einstein allegedly called the eighth wonder of the world. In the next chapter, we'll explore why compound growth quietly creates fortunes, and why most people underestimate its power for decades. Imagine receiving a single grain of rice today. Tomorrow it doubles. The next day it doubles again. At first, the growth seems almost meaningless. 1 grain becomes 2. 2 become 4. 4 become 8. Hardly impressive. But something remarkable happens as time passes. Growth that once seemed invisible begins accelerating. Eventually, each new increase becomes larger than everything that came before it. This is one of the most important ideas in investing, not because money grows magically, but because consistent growth builds upon previous growth. Small gains begin generating gains of their own. Over years and decades, this creates results that feel almost disproportionate to the effort required. The mathematics are simple. The patience is difficult. If compound growth is so powerful, why don't more people benefit from it? Because compounding has an enemy. Actually, it has several. Impatience, high costs, frequent trading, emotional decision-making, lifestyle inflation. Every unnecessary interruption resets the process. Imagine climbing a mountain. Every few minutes you choose to walk back downhill. Eventually you'll reach the summit, but much later than someone who simply kept moving upward. Investing works in a remarkably similar way. The market doesn't require perfection. It rewards consistency. When people study Warren Buffett, they often focus on the size of his fortune. But the more interesting lesson isn't how much wealth he accumulated. It's how long he allowed compounding to work. Much of Buffett's wealth was created later in life because his capital had decades to grow. His story reminds us that compounding isn't just about earning returns. It's about giving those returns enough time to multiply. Time quietly becomes one of the most valuable assets an investor can own. Consider two hypothetical investors. Both invest the same amount every month. Both earn similar long-term returns. The difference: one starts at age 25. The other waits until 35. That 10-year delay may seem insignificant. Yet over several decades, it can lead to dramatically different outcomes. Not because the second investor made poor investments, but because time itself was working for one investor much longer. Time compounds, discipline compounds, habits compound, even knowledge compounds. We often think of compounding as a financial concept. In reality, it's a principle of life. Reading one book rarely changes your life. Reading 100 books often does. Exercising once changes very little. Exercising consistently for years transforms your health. Small daily improvements become extraordinary when enough time passes. Investing follows exactly the same pattern. Modern financial media encourages activity. Buy, sell, react, predict, repeat. But every unnecessary decision introduces the possibility of mistakes. The world's greatest long-term investors rarely became successful because they made more decisions. They became successful because they made fewer, better decisions. Simplicity often outperforms complexity. Not because simple strategies are exciting, but because they are easier to maintain for decades. Evergreen principle number 2. Time is your greatest financial asset. Money can be replaced. Opportunities return. Markets recover. But lost years never come back. Every year you remain invested gives compounding another chance to work quietly in your favor. But if time is so important, why do intelligent people still make costly investing mistakes? Why do experienced investors panic during market crashes? Why do bubbles continue appearing throughout history? The answer has surprisingly little to do with mathematics. It has everything to do with human psychology. In the next chapter, we'll discover why your greatest advantage or your greatest enemy is rarely the market itself. It's the person looking back at you in the mirror. Imagine walking into a room with the greatest investors in history: Warren Buffett, Benjamin Graham, Charlie Munger, John Bogle, Peter Lynch, Ray Dalio. They all invested differently. They lived in different decades. They built wealth through different strategies. But if you asked each of them what causes most investing failures, none would point to the stock market itself. They would point to something much closer: human behavior. Because investing is one of the few activities where intelligence alone is rarely enough. A brilliant investor with poor emotional discipline often underperforms an average investor with patience and consistency. The market doesn't simply test your knowledge. It tests your character. Every investor enters the market carrying an invisible backpack. Inside are fears, hopes, biases, memories, past mistakes, and emotions. These invisible forces quietly shape decisions long before logic has a chance to speak. During rising markets, confidence grows. During falling markets, fear takes control. Yet the market itself hasn't changed. Only our emotional response has. This is why two people can look at exactly the same chart and reach completely different conclusions. One of the most studied concepts in behavioral economics is loss aversion. Research by psychologists Daniel Kahneman and Amos Tversky showed that people typically feel the pain of losing more intensely than the pleasure of gaining the same amount. Imagine finding $100. Feels good. Now imagine losing $100. For most people, that feeling is much stronger. Markets exploit this tendency every day. When prices fall sharply, fear convinces investors that selling feels safer than staying invested. Yet history repeatedly shows that emotional decisions made during moments of panic often become the decisions people regret the most. Human beings evolved to survive in groups. Following the crowd was often the safest strategy. In financial markets, the opposite can sometimes be true. Think back to famous market bubbles. During the dot-com boom, people believed technology stocks could only go higher. During the housing boom, many assumed real estate prices could never fall. During every major speculative cycle, optimism reaches its highest point just before reality changes. By the time everyone agrees something is a great investment, much of the opportunity may already be behind them. That's why disciplined investors spend less time asking, "What is everyone buying?" and more time asking, "What principles should guide my decision?" Another psychological trap is overconfidence. After a few successful investments, it's easy to believe our success came entirely from skill. Markets have a way of humbling certainty. Bull markets can make almost everyone feel like a genius. Bear markets remind us how little control we actually have. The best investors remain humble, not because they lack conviction, but because they understand uncertainty. They prepare for outcomes they cannot predict. Few emotions are stronger than watching others appear to get rich without you. A stock doubles. A cryptocurrency surges. Headlines celebrate overnight fortunes. Social media fills with screenshots of extraordinary gains. Suddenly, patience feels like failure. This emotion has a name: fear of missing out, FOMO. It encourages investors to abandon carefully built plans in exchange for excitement. Ironically, the greatest fortunes in history were rarely built through excitement. They were built through consistency, through repetition, through discipline, through staying invested while everyone else searched for shortcuts. Imagine watching a world-class chess player. They don't panic after one bad move. They don't redesign their entire strategy every 5 minutes. They focus on position, probability, long-term advantage. Great investors think remarkably similarly. Every market movement doesn't require action. Sometimes the most intelligent decision is simply to do nothing. Evergreen principle number 3. Discipline beats prediction. You don't need to know what the market will do next week. You need a system that still makes sense 20 years from now. Predictions expire. Discipline compounds. But discipline alone isn't enough. Even the most disciplined investor still faces one critical question. What should you actually own? Stocks? ETFs? Index funds? Individual businesses? Cash? Diversified portfolios? To answer that, we need to learn from the people who spent their entire lives thinking about one question. How do you build wealth that lasts? And that journey begins with some of history's greatest investors. Imagine asking 6 of history's greatest investors the same question. What is the secret to building lasting wealth? You might expect 6 completely different answers. After all, they invested in different decades, different markets, different companies, different economic environments. Yet something remarkable happens when you study them closely. Their methods vary. Their principles converge. Markets changed. Human nature didn't. That's why their lessons continue to matter today. Let's begin with Benjamin Graham, often called the father of value investing. Graham taught investors to make one distinction that remains surprisingly difficult. Price is what you pay. Value is what you receive. Every day, markets attach prices to businesses. But prices move because of emotion, headlines, optimism, and fear. Value changes much more slowly. Graham believed investors should think like business owners, not traders. Imagine buying a small bakery in your neighborhood. Would you sell it simply because someone offered you a lower price tomorrow? Probably not. You would ask better questions. Is the bakery profitable? Are customers returning? Is the business improving? Investing in public companies requires the same mindset. Stocks are not lottery tickets. They represent ownership. Graham's student Warren Buffett expanded that philosophy. Buffett realized that buying great businesses at reasonable prices often produces better long-term results than buying average businesses simply because they appear cheap. He frequently reminds investors that the stock market exists to serve them, not instruct them. Every day, the market offers a new price. You are never obligated to act. That idea sounds simple, yet it quietly removes enormous emotional pressure. You don't have to respond to every headline. Sometimes patience is the highest return decision available. Buffett often credited much of his thinking to his longtime partner, Charlie Munger. Munger believed investing was less about predicting markets and more about improving the quality of your thinking. He encouraged investors to study psychology, history, mathematics, biology, engineering, and economics. Why? Because reality is interconnected. Better decisions come from understanding how systems interact, not from memorizing stock tips. Knowledge compounds just like capital. Every new mental model becomes another tool for solving future problems. While many investors searched for increasingly sophisticated strategies, John C. Bogle asked a radically different question. What if simplicity wins? Bogle championed low-cost index investing, arguing that for many people, consistently owning a broadly diversified portfolio and minimizing costs could outperform the endless search for the next winning investment. His philosophy wasn't exciting. It was durable, and durability often matters more than excitement. Peter Lynch encouraged investors to stay curious about the world around them. Some of the best ideas, he argued, begin with careful observation. Businesses people use every day, products families rely on, companies solving real problems. His lesson wasn't to invest blindly in familiar brands. It was to begin your research where genuine understanding already exists. Curiosity should lead to investigation, not assumption. Finally, consider Ray Dalio. Dalio spent decades studying economic cycles and managing risk. His philosophy begins with a simple admission. The future cannot be predicted with certainty. Because uncertainty is permanent, portfolios should be built to withstand different environments rather than relying on a single forecast. Diversification is not a sign of indecision. It's an acknowledgement of humility. The goal isn't to be right all the time. The goal is to remain resilient when you're wrong. At first glance, these investors appear very different. Graham focused on value, Buffett on quality, Munger on multidisciplinary thinking, Bogle on simplicity, Lynch on observation, Dalio on diversification. Different philosophies, different language, yet beneath the surface they share the same foundation. They think in decades. They respect uncertainty. They control risk. They avoid emotional decisions. They continue learning. Most importantly, none built lasting wealth by chasing yesterday's headlines. Evergreen principle number 4. Own principles before you own assets. Assets can lose value. Markets can decline. Strategies evolve. But sound principles continue guiding intelligent decisions through every market cycle. By now, one conclusion is becoming impossible to ignore. Wealth is rarely created by discovering secret investments. It's built by repeatedly applying timeless principles. But knowing these principles still leaves one practical question. If you were starting from zero today, what would you actually do? That's exactly where we're going next. Imagine that today is your first day as an investor. You don't have decades of experience. You don't have insider knowledge. You don't have a perfect understanding of financial markets. That's completely normal. Every great investor started exactly where you are now. The question isn't, how can I become an expert overnight? The better question is, what system can I build that still makes sense 30 years from now? Because systems outlast motivation. Systems reduce emotional decisions. Systems create consistency. And consistency is where wealth quietly begins. Imagine constructing a skyscraper. Would you begin with the top floor? Of course not. You begin with the foundation. Personal finance works the same way. Before thinking about maximizing returns, ask a more important question. Could my financial life survive an unexpected setback? An emergency fund is not an investment strategy. It's a resilience strategy. Creates breathing room. It prevents short-term problems from forcing long-term investing decisions. Great investing begins with financial stability. Not all debt is the same. Some forms of borrowing may help finance productive assets or education. Others carry high interest rates that can quietly erode future wealth. Every dollar paid in unnecessary interest is a dollar that can no longer compound for your future. Before chasing higher returns, understand the guaranteed impact of reducing costly financial obligations. Sometimes the best financial decision isn't finding a better investment. It's eliminating an expensive obstacle. Many people believe successful investing depends on finding the perfect moment to begin. History suggests something different. Consistency has often mattered more than precision. Instead of asking, "Is today the perfect day to invest?" consider asking, "Can I build a habit that continues regardless of headlines?" Markets rise. Markets fall. Life becomes busy. Unexpected expenses appear. Habits continue. The most valuable investment plan is often the one you can realistically maintain through changing circumstances. Every time you invest in a productive business, you're becoming a partial owner. Ownership changes perspective. Imagine owning a local grocery store. Would you check its value every 5 minutes? Probably not. You would focus on customers, products, revenue, long-term improvement. Public markets tempt us to confuse price movements with business performance. Ownership reminds us to think beyond today's quotation. Diversification is sometimes misunderstood. It isn't about owning as many investments as possible. It's about recognizing a simple truth. The future is uncertain. No investor can predict every technological breakthrough, every recession, every geopolitical event, every innovation. Diversification accepts uncertainty instead of fighting it. It replaces confidence with resilience, and resilience often proves more valuable than certainty. Markets evolve, businesses change, new technologies emerge, economic conditions shift. The investor who stops learning eventually begins relying on outdated assumptions. Learning isn't preparation for investing. Learning is part of investing. Every book, every annual report, every economic lesson, every historical case study, each one strengthens your future decisions. Imagine two investors. The first depends on motivation. They invest only when they feel confident. They stop during market declines. They wait for certainty before taking action. The second follows a written system. They continue learning. They review their plan periodically. They understand that uncertainty is normal. Over decades, the difference between these two approaches becomes enormous. Not because one investor predicted the future, but because one built a process that survived uncertainty. Evergreen principle number 5. Build systems, not predictions. Predictions expire quickly. Systems improve through repetition. A written investing process can guide you when emotions become loud. And emotions always become loud eventually. By now, we've explored history, psychology, compounding, legendary investors, practical frameworks. But one final question remains. If all these principles are so powerful, why do so few people consistently apply them? The answer has nothing to do with intelligence. It has everything to do with patience. And that may be the rarest investing skill of all. Let's bring everything together. Imagine meeting two people. One spends every day searching for the next hot investment. The other quietly follows the same simple principles year after year. At first, they look remarkably similar. Weeks pass. Months pass. The difference is almost invisible. But investing is one of the few disciplines where the biggest rewards often remain hidden until much later. Then one day, the gap becomes impossible to ignore, not because one person discovered a secret, but because one person remained consistent while the other constantly started over. Throughout this documentary, we've explored market history, human psychology, legendary investors, the mathematics of compounding, and practical frameworks for long-term investing. Yet every lesson points toward the same conclusion. Wealth is rarely built through extraordinary predictions. It is built through ordinary decisions repeated consistently over extraordinary periods of time. Before we finish, let's revisit the principles that appeared throughout this documentary. Not because they are new, but because they continue proving themselves across generations. Evergreen principle number 1. Volatility is temporary. Ownership is permanent. Evergreen principle number 2. Time is your greatest financial asset. Evergreen principle number 3. Discipline beats prediction. Evergreen principle number 4. Own principles before you own assets. Evergreen principle number 5. Build systems, not predictions. The 6th principle, and perhaps the most important principle of all. Never stop learning. Markets evolve. Businesses evolve. Technology evolves. Economies evolve, but curious investors evolve with them. Financial education isn't something you finish. It's something you continue for the rest of your life. Every great investor has a library, books, annual reports, letters, case studies, history, because wealth begins in the mind long before it appears in a portfolio. That's exactly why this channel exists. Not to predict tomorrow's market, but to build a timeless library of investing knowledge you can return to again and again. A place where principles matter more than headlines, where evidence matters more than hype, and where every documentary helps you become a calmer, wiser, more disciplined investor. Markets will continue changing. New technologies will emerge. New crises will appear. New opportunities will be created. But the investors who consistently succeed will likely share something in common. They won't know the future. They'll understand the principles that survive it. Because markets change. Principle, less don't. If you believe investing should be based on knowledge rather than noise, on discipline rather than emotion, and on timeless principles rather than temporary trends, you're in the right place. Subscribe to Evergreen Investor and join us as we build one of YouTube's most complete libraries of long-form investing documentaries. Every episode is designed to remain valuable, not just next week, but for years to come. And if this documentary helped you see investing from a new perspective, consider sharing it with someone beginning their own journey toward financial education. Thank you for watching. We'll see you in the next documentary.